Welcome to the Athenian Bull, your go-to channel for financial education. If you're looking to build wealth, grow your investments, and make smarter financial decisions, you're in the right place. Today, we're breaking down how to invest in stocks as a beginner, step by step. By the end of this video, you'll know exactly how to start investing and avoid costly mistakes. Thinking about investing but feeling overwhelmed? You're not alone. The stock market can seem complex, full of numbers and confusing financial terms. But here's the truth: investing is the best way to build wealth over time, and anyone can do it. Did you know that if you had invested just $1,000 in Amazon stock in 1997, it would be worth over $1.5 million today? The stock market has created more millionaires than any other investment method. But where do you start? How do you choose stocks? And how do you avoid losing money? In this video, I'll take you through a simple, step-by-step guide on how to invest in stocks as a beginner. Stick around until the end, where I'll reveal 3 major mistakes most new investors make, and how you can avoid them. Let's start simple. Stocks represent ownership in a company. When you buy a stock, you're not just purchasing a digital asset, you're buying a small part of a real business. Companies sell stocks to raise money, and in return, investors get a share of the company's future success. For example, in 1998, Amazon stock was just $1 per share. If you had invested just $1,000, you'd now have over $1.5 million. That's why long-term investing is so powerful. There are 2 main ways to make money from stocks: capital gains and dividends. Capital gains: this happens when you buy a stock at a low price and sell it at a higher price. For example, if you buy Tesla stock at $50 per share and it rises to $500 per share, you've made a 900% profit. Dividend: some companies share their profits with investors through dividends. These are cash payments sent to your account every few months. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have paid dividends consistently for decades. If picking individual stocks feels too risky, there are safer ways to invest. Let's talk about ETFs and mutual funds, which are great for beginners. Buying individual stocks can lead to high rewards but also comes with higher risk. If you invest in a single company and it fails, you lose money. ETFs are a basket of stocks that track an index like the S&P 500. When you invest in an ETF, you own a small portion of many different companies at once. This means lower risk and automatic diversification. Mutual funds are similar to ETFs but managed by professionals. While they offer good diversification, they often come with higher fees than ETFs. For beginners, ETFs like SPY, S&P 500, or VU, Vanguard's S&P 500 fund, are an excellent starting point. Before you can start investing, you'll need to open a brokerage account. A brokerage is an online platform where you buy and sell stocks. Some of the most popular brokerages include Fidelity, Vanguard, Interactive Brokers, and Robinhood. Look for one with low fees, an easy-to-use interface, and strong customer support. After signing up, you'll need to transfer money from your bank account to your brokerage. Most platforms allow deposits via bank transfer or debit card. Once your account is funded, take some time to research stocks and ETFs before making your first investment. Once you have performed adequate due diligence, it's time to buy your first stock or ETF. Decide how many shares you want to buy. If you don't have enough money for a full share, some brokerages offer fractional shares, allowing you to invest as little as $5 or $10. Once you enter the number of shares, click buy and confirm the trade. Congratulations! You're now an investor. Now, in order to build long-term wealth, you need the right investing strategy. Let's go over 3 beginner-friendly approaches. 1. Long-term investing. This is one of the safest strategies, buying stocks and ETFs and holding them for years. History has shown that the market always trends upward over time. 2. Dollar cost averaging. Instead of investing all your money at once, invest a fixed amount every month, no matter what's happening in the market. This helps you avoid buying at high prices. 3. Diversification. Never put all your money into one stock. Spread your investments across different sectors and ETFs to reduce risk. Now, before you start investing, you must avoid these 3 common mistakes that cost beginners thousands of dollars. 1. Trying to time the market. No one can predict the perfect time to buy or sell. Consistent investing beats market timing every time. That is why DCA is a good method for beginners. 2. Investing without research. Never buy a stock just because it's trending. Always study a company's financials and long-term potential. 3. Panic selling. The market has ups and downs, but over the long run, it always recovers. Patience is key. Now you know exactly how to start investing. If you found this helpful, hit like and subscribe for more investing content from the Athenian Bull.